Hey guys, it's Craig from Wattle Accountants. Today we're going to talk about the most common structures for small businesses in Australia. So let's get started. The first one is the sole trader structure. So basically it's when you're trading as a business in your personal name. So the advantages here are you don't need to prepare a separate tax return, which is easy. The registration process is cost effective. In fact, there's no cost. You can just complete the ABN, Australian Business Number registration yourself. The disadvantages here, you obviously can't go into business as a sole trader with someone else, so that won't work here. The tax rate can be varied, so it can be anywhere from 0 to 47%, which depending on how much money you make is not going to be a good strategy. Another big disadvantage is if your business fails, your personal assets can be taken by your creditors, so you're personally liable for those. So if you real estate or investments, so you might be this structure may not be right for you, but once again it's a great structure if you're looking to start a business. There's also a small business restructure that you can apply later on if you plan on moving a business to a different structure, effectively tax-free. We highly recommend speaking to an accountant before you do that. We have personally seen many situations where people do that themselves, and there's severe tax consequences as a result. So the next structure we'll talk about is the partnership. So in this situation, commonly you've got two individuals, husband, wife, two friends. They work in the business together, so they form a partnership, which is just an agreement. So you'll have to register an ABN for the partnership. We recommend having a partnership agreement. Speak to a lawyer, especially if they're an unrelated party. You want to make sure that you in the event of a dispute, know what you can and can't do. So one of the advantages here, you're able to split the profit. Usually, say if there's two partners, it's going to be 50-50 equally. Another common situation that this is a great structure for is where you've got one partner that actually works in the business, and then say the other partner they finance the business, and this guy works in the business. So within your agreement, you can specify the salary that the partner one gets. So you're able to sort of split the earnings from your partnership with relative ease. So the main disadvantage here is there's an additional cost because you've got another tax return. It's not a big deal, I think, but the big thing is that the individuals or the partners are personally liable for the debts of the business. So once again, if you got lots of personal assets, usually you want to be careful with that. Partnerships can also be not only for individuals, but you could have two companies. But once again, these are the most common structures. Usually it's two friends or husband-wife sort of thing. The next most common structure is the company structure. So in this situation, you've got the company, and it controls and runs this business, and is controlled by the director here. In this situation, when it makes money, it pays it out as a dividend, usually to the director, which is also the shareholder. So clearly there's a potential issue there, is that all the profit goes into one person's tax return, which may not be favourable. The main advantage here, though, is the limited liability. So if this company makes a mistake, the director and the shareholders, all their personal assets are safe. The director, though, can be potentially liable for the debts of the business if they don't meet the obligations as a director. The most common one is making sure this company is solvent at all times. If it's not, you need to close it down right away. So in this situation, you'll also have an additional fee you've got to pay every year to ASIC, the regulator. So it's about $300 a year. The fees to set up a company is usually about $500-600. The filing fee for ASIC to register the company. Okay, so now we'll go on to the last two most common structures, and they involve a trust. Okay, so the first one is where you have a trust with a company trustee. So in this situation, the business is owned by a trust. Trust is basically an arrangement between two different parties. So you've got the trustee. In this situation, the company controls the trust. That's the trustee. Then they do that for the benefit of these beneficiaries, which is usually yourself down here. So what happens is the business is run by this company. The trust makes the profit from the business, and then it allocates out the income to your beneficiaries, which are usually yourself and your family. Just like before, the company also has a director that controls this company. So the main advantage here is the profit can be allocated as you see fit. So the director could get 50K, the spouse gets 20K, and $100 each, something like that for the children. So you can allocate it on a year-by-year basis. So there's a lot of flexible planning involved with that, which is great. Another benefit is that the trust, if it earns different types of income, so you've got business income, interest, capital gains. So capital gains is the most common one where there's concessions you can apply. So the trust basically passes through the income in its same characteristics, which means the beneficiaries here, when they receive it, can apply those concessions, which you'll see in the next scenario. You can't do that. So that's another sort of big, a great reason to have your business owned by this trust. So cost-wise, the trust here will have a tax return. The company, because it's not making any money, it doesn't have a tax return, so it's just like before, just setup fee for the company. The fees to set up a trust can be anywhere from sort of $200 to $1,000 or more, depending on if you have specific needs that you want around your trust. But sort of standard trust can be sort of $500-600. The director, once again, is controlling this company, so just make sure that you're meeting those obligations because the company is responsible if the trust fails. So in that situation, everybody's safe here as long as the company is solvent and the trust is actually solvent as well. Okay, so the next structure that's quite common is where you have a company, but the shareholder is the trust. So in this situation, the company has the business, so it's making all the money, and then when the profit is made by the company and it's drawn to the shareholders or the owners, they want to take the money from the company. It all gets basically washed down into one type of income called dividend. So like I mentioned before, it doesn't stay the same type of income as what it was earned. It basically gets all turned into just a dividend. So it's only one type of income where there's no concessions. It's just a dividend. So in this situation, the dividend will go to the trust, and then you can then split it to the beneficiary. So half the dividend can go to the director, half of the dividend can go to the other spouse. So you have that discretion on a year-by-year basis. So it's still a great structure regardless. The company is once again controlled by the director, so making sure this company is solvent at all times. One of the disadvantages with this structure is that obviously the whatever profit the company makes, it becomes a dividend. It won't stay, say, a capital gain. But you technically can retain the profit in the company if you don't draw it. But the reality is with small businesses, if it makes, say, a profit of $100,000 in the company or in your business, you're going to want to take that money to fund your expenses. So effectively, the concessional tax rate or the tax rate for the company doesn't matter because all of it will just come out and it'll be taxed in your own name. So it doesn't really matter what the company tax rate is. I've actually done a separate video just to explain why that is the case. However, it is still a good strategy because you have the trust. You're able to split the dividend, the profit on a year-by-year basis. So yeah, thanks for watching the video. If you thought it was insightful, give us a like. Or if you've got any questions, leave a comment down below. Otherwise, thanks for watching.